All right, so Michael, let's talk, let's hone in on silver for a bit here. Silver's been on a rampage higher. It has been relentless. Today, at one point, it was up over 117. This move is making many nervous.
Hmm.
All over X, there's people calling for a top. There's
Hmm.
a number of self-proclaimed experts predicting disaster is
Hmm.
rising. So let's start here. Silver ripped to 117. It did a hard reverse down to 107. What are you expecting for silver? And are they premature in calling for a top, or is today the makings of a top with that reversal?
Hey everyone, great to have you here. So I just watched this interview with Michael Oliver from Momentum Structural Analysis, and he's making some absolutely massive calls that honestly stopped me in my tracks. He's not just saying silver's going higher, he's projecting $300 to $500 silver by this summer, explaining why we're in what he calls a new reality after 50 years of price suppression, and breaking down the exact timeline for when he expects a pullback and why it won't be the top. The math he's using based on historical gold-silver ratios is genuinely mind-blowing. Make sure you stay through to the end, because the way he connects the bond market crisis to what's about to happen in precious metals is something you absolutely need to hear. Oh, and real quick, drop a comment below and let me know what part of the world you're tuning in from. I'm always curious to see where everyone's watching. All right, let's dive in.
Its founder and its host, Gary Bohm. Today, we have an extremely timely and a very important discussion lined up on the metals, the miners, and the markets. And we're fortunate to have with us Michael Oliver, founder of Momentum Structural Analysis. Michael, it's always a privilege to have you back on Metals and Miners. Welcome to the
It's
show.
good to be back on, Gary. Yeah.
Well, great.
Thank you.
All right. Hey, so Michael, for decades and multiple market and business cycles, you've been analyzing markets through this lens of structural momentum technical analysis. We're currently in the next great precious metals bull cycle, and we're seeing some things that are really unprecedented right now. It's leaving most in shock and some worried about what comes next. What do you hope for those tuning into this discussion that they're going to walk away with after hearing it?
Well, you used the word, I think, unusual or something, and that's dead right. That's the word. Don't expect the normal. Yeah, bull markets come and go. They get overdone. They correct. And so this is a move by silver into a new reality. That's the best way I can phrase it. We've used that for about 6 months now. The old reality was a 50, half a century price range. $4 to 50, $4 to, yeah, et cetera. Just caught in this range. And frankly, while gold in that same period of time would take out its prior high by many multiples. Well, silver was still contained in a little box. Like, we don't need silver anymore. Well, they find out they do. Okay. They needed an AI. They needed, all this stuff, solar panels, the whole thing. So there's a new reality there fundamentally in terms of the industrial demand versus the supply deficit. Okay. But it's still money. People forget that. They don't consider it the same as gold. Well, humankind has, for 3,000 years. And right now it is very cheap. Ounce of silver, respect to an ounce of gold, it's like 2% right now. Early this year, silver was like 1% of the price of gold. So it's had a huge move. When you go from 1 to 2, that's a doubling. Okay. So it's definitely caught up, but it's old reality when you measure that ounce of silver versus the mama metal, the monetary metal. Back in the 79 to 80 bull market, when silver, again, in that box, $50 peak, ran up to $50, and it was 6.5% of the price of gold. In fact, it stayed up there a while too. For a couple of years, it was in that 6 zone. Okay. Then in the 2011 bull market, when we went from like 10, $15 up to 50, took a couple of years, a lot of it in the last couple quarters of that move, just like in 79, 80. Silver reached a relative peak to gold of 3.1%. Okay. So even right now at 2.1%, we're still cheap. So if price broke out of its confinement range of a half century, consider the possibility that silver could reassert itself as the baby monetary metal. and get maybe back up to the highs it saw in the last 50 years, which say 6+%, 3+%. Wow. I mean, and consider also the fact that it's not going to do that with gold going down and silver going up. They're both going to be going up. Silver's going to be going up more. So good grief. I mean, if silver were 3% of even current gold, we'd be like $150. But if gold goes on up, I've speculated on this before. It's just a truth. It's not a projection, actually. The two prior bull markets in gold were 8-fold dimension. Bear low to bull high, bear low to bull high. If you measured the dimension, the logarithmic scale, it was an 8-fold gain. Well, heck, if we do an 8-fold, gold's going to be $8,500.
This is the conversation everyone in precious metals needs to hear. Michael Oliver just revealed something critical most investors are missing. He said silver is moving into a new reality after being trapped in a 50-year price range, $4 to 50. For half a century, silver stayed in a box while gold multiplied over and over. That's not natural. That's suppression. And now that box just got obliterated. Here's the math that should blow your mind. Early in 2024, silver was 1% of gold's price. We're now at 2.1%. But in the 2011 bull market, silver hit 3.1% of gold. In 1979 to 1980, it reached 6.5% and stayed there for years. Even at $32 today, we're still historically cheap relative to gold. Now here's where it gets wild. Michael said if silver were just 3% of current gold prices, you'd be looking at $150 silver. But he goes further. The last two gold bull markets were 8-fold moves. If gold does another 8-fold, we're talking $8,500 gold. And if silver gets back to just 3% of that, we're in the hundreds of dollars per ounce. If it reaches that 6% level from 1980, you do the math. This isn't speculation. This is historical precedent with fundamentals that are stronger than ever. The industrial demand for silver in AI, solar panels, and green energy wasn't there in 1980 or 2011. Now it is, and there's a massive supply deficit that hasn't been priced in yet.
Probably into summer, June or July, there will be a jiggle in the middle. And I don't mean what we saw today or these jiggle that really, you can see it on a monthly chart, for example, not just a daily. I don't think we're there. I strongly suspect that jiggle won't even occur until we get into like later in this coming month or March, and probably at much higher levels than we saw today. But even that jiggle is not the top. It's just a midpoint,
What's the indication that you're looking for that says that jiggle is imminent?
We're looking at monthly momentum of silver. We're also looking at the clock because those spread breakouts were very good clock metrics back in 79 to 80 and in 2010 to 11. When silver has already been in a bull market for years, suddenly it goes ape on the upside. And the signal that warned that wasn't something to do with silver itself. It had to do with the relationship to silver to gold, where silver said, I'm mad, I'm coming out of here. You've kept me down for too long relative to the mama metal. And it went on a tantrum. And again, it went to 6.5% of gold in that 79 to 80 move. And it went from like 1.5% to 3% in that 2010 to 11 move. We're only at 2.1%. So we're hardly overdone. The spread only just broke out 7 weeks ago. So it's not old on the clock. And when you factor in, again, the degradation in the money unit and say, well, silver's at least going to regain its value of what it was in 1980 or 2011 relative to where the dollar real buying power is now. In other words, take an M2 chart and factor its upside increase, do that to silver. Silver would be a couple $100 just to match that.
So early March timeframe would be the clock, and then
Yeah, let's say in a month or so. I'd be
roughly, yeah,
looking for
end of February, beginning of March.
I'd be looking for a jiggle there. It wouldn't just be the clock, it would be we look at weekly momentum of silver, week by week momentum action, not so much the price, and month by month, monthly momentum action.
Do you
And
think you'll
neither
see it
one,
before? Do you think you'll see it before it shows up?
they should give warnings before, and they did back like in 79 to 80, there was a jiggle in the middle where you had not a down month, but like a period where you could plot on 1 month to the next month to the next where the price was redundant. So in other words, you could have bought and sold at the same price for a 3-month period, up, down, okay? And in 2010 to 11, there was actually a reversal month. In January of 2010, the buy signal was in September of 2010, the spread breakout. It ran up to January high and reversed. You had a total collapsing month in silver. And you ended up closing that month out, January, the reversal month, something the price chart guys would go crazy about. That's the top, right? Okay. Turned around and went up even more by April than it had in the first part of the move.
Are you expecting a dramatic impact on the miners, the related miners during that wiggle period?
We have an interesting situation there. The miners collapsed in relative value to gold between 2008 and 2015. Put it this way, XAU index, which has been around since 1980, so let's use it. It's gold and silver miner index. It lived in a relative performance status to gold, either side of about 25% of the price of gold. It dropped down to 17, 18% of the price of gold. Again, divide XAU into gold. And it would get up to 35%. So you could draw a line through this multi-decade range, and then we collapsed to 4% in 2015 when the bear market low occurred, and gold also in this spread. 4% in something that used to be, on average, 25% of the price of gold. The miners were like free.
Michael just revealed the exact timeline driving this silver explosion. He explained the spread relationship between silver and gold broke out of a massive basing pattern in November 2024. When that happened in 1979 and 2010, silver went absolutely berserk, tripling or quadrupling in a handful of months. We just broke out in November, so we're only a month and 3/4 into what he calls the unleashing. Now here's what everyone's freaking out about. Silver hit 117 and reversed to 107, and people are screaming it's a top. But Michael says ignore them. There have been teen reversals over the last few months, and each time they get briefer. What used to be weeks became days, then intraday moves. That's not weakness, that's volatility compression in a market about to explode higher. Here's the key timing. Michael said, probably into summer, June or July, there will be a real pullback. But he strongly suspects it won't occur until late February or March, at much higher levels. So if we're at 117 now, and the pullback comes at higher levels, we could be looking at 150, 200, maybe higher before that happens. And even that isn't the top. It's just a midpoint. Then Michael dropped the bomb. He said, we're not just going to see $200 silver. We're more likely to see $300 to $500 silver by summer. We're at $32 today. He's talking about a 10 times to 15 times move in 6 months, based on historical precedent. Copper did this in 2005 to 2006, lead in 2007. Silver is doing it now. The unleashing has only just begun.
One, I'm not looking for a bear market on the other side. What I'm looking for is we reach a new reality, a relative performance reality of miners to the stock market, gold to the stock market, silver versus gold. All these relationships are going to change and go to a more normal reality based on factoring in such things as the decay in the money unit, the M2 chart, okay, reflecting that to some extent. The miners, I mean, if you like gold and say, oh, we should be in gold, well, why not the miners? They used to be 25% of the price of gold. Now they're 8, and that's a rally, and they're still dirt cheap. You can't have your gold if you don't have the miners or the silver that you really need. It's the miners are going to get it out of the ground for you. So, the logical connection, they're not making it. Okay. And there's a point, I love it because I don't look at the internet stuff. My son does. And he tells me what this consensus is out there. And it's always a top. I mean, they've been saying that for a year, And I would just love every time they said that, just circle the silver chart where there was a consensus, just circle it. And every time you had that circle, if you bought it, you did quite well.
Well, we could put another circle around 117 today because everywhere you look, people are already
Oh,
saying,
sure. Yeah. So, and if in 2 days or a week, we're suddenly 125 and 130, they'll say, well, what do I do? I got out.
So another narrative, another worry is that the gold and silver price movements are not just reversion to the mean, something that should have happened a long time ago. They've been held down, undervalued, underowned, et cetera. Rather, they are a early warning system that something big has broken and there's major problems coming.
Yeah.
What is your take on that?
Oh, yes. That's exactly what our take is. Gold is, well, the oldest market we're dealing with here, thousands of years. So is silver. Okay. They tried to interject crypto into the monetary mix, like, oh, here's a new alternative, and then suddenly that ain't working. Okay. And plus, when you run spreads of Bitcoin versus gold, it's collapsed. And silver, you should see it. It's like an implosion. And they broke down about 4 or 5 months ago, even before price did. But there is an underlying reality, and it's not just in gold and silver. It's not just silver industrial demand. It's the monetary factor. And we've had like a century now of the central banks, what's 110 years on the Fed, something like that, manipulating the price of money, meaning interest rates, at literally government edict, okay? Not a free market, and it's an essential commodity of human interaction, the currency that we use to buy and sell things, okay, between us and the guy you don't even know on the other side of the world, maybe, and hopefully that you're giving him money that actually holds its value. And he's getting what he thinks, and in 2 weeks it doesn't decay. But anyway, that's controlled by governments now, not free market pricing money, and they determine the quantity. That's like a government, in China after Mao, about 20, 30 years later, who was it? The guy who followed him privatized agriculture because they had a monopoly on the quantity of grains and the price of grains, and it wasn't working. And when they privatized that, hey, it worked. And they've since privatized a lot of things. But we still have government monopoly over the quantity and pricing of money. It's not working. And when you break the stock market and people start to hurt again, because that's the only thing they got to smile about, unless you're in gold, is, hey, my retirement account's up 15% last year, if they match the S&P, if they were lucky enough to match that. And, if all of a sudden, middle of this year, you've wiped out last year. And then that's like 5,800 we wipe out last year on the S&P. So about, we're 68 and 69. So not a huge percent drop. You'll have wiped out all of 2025. And the guy with his retirement account is late on his credit card and wants to retire. Suddenly his retirement account just dropped 30%.
Michael just connected all the dots on why this is happening and what's coming next. He said gold and silver are the oldest markets, thousands of years, and there's an underlying reality that's not just industrial demand. It's the monetary factor. For over a century, central banks have been manipulating interest rates and currency quantity, and it's not working anymore. When the stock market breaks and retirement accounts are the only thing people have to smile about, that's when emotion hits the markets like never before. Here's where it gets intense. Michael's watching the bond market because that's the trigger. T-bond futures were at 117, collapsed to 115, and have been held there in the quietest price action he's ever seen. The Fed admitted they're buying bonds to hold the market together with printed money. But if bonds slip just 3 or 4 points below current levels, you could have a mini panic. And what happens then? They will print, print, print with hoses bigger than we can imagine. But investors won't buy more bonds. They'll say this is too risky and put it into that 20% gold allocation institutions now recommend. It used to be less than 1%. That's a structural shift. Michael compared this to 2000 and 2008. When the Fed cut rates aggressively, stocks dropped anyway, but gold and miners took off during the bear market. This time is worse because it's a sovereign debt crisis. When that breaks, metals and miners will explode, not drop. This is a regime change. We're not at the end, we're at the beginning of the unleashing. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.